You got the job. The offer letter said $30,000 a year. You did the math in the parking lot. $2,500 a month. You could make this work. Your first paycheck was $1,012, not $2,500, not even close. Federal tax, state tax, Social Security, Medicare, health insurance you didn't fully choose. By the time the number hit your account, $30,000 a year had become $12,144 you could actually spend. 40.5% of your salary existed only on paper. You weren't broke because you spent too much. You were broke because the number on the offer letter was never the number that mattered. At $30,000 a year, the system charges you to participate in it before you see a dollar. Here is what changes at every salary level, and here is the number that matters at each one. You are making $30,000 a year. Your take-home is approximately $1,780 a month after taxes and standard deductions. Rent in most mid-tier American cities runs between $900 and $1,100 for a one-bedroom. That leaves you between $680 and $880 for everything else. Utilities, food, transportation, phone. At this income, you have no margin. A $400 car repair is not an inconvenience. It is a decision between that and rent. Your savings rate is functionally zero. Not because you are undisciplined, because the math does not allow it. A financial advisor would tell you to save 10% of your income. 10% of $1,780 is $178. After rent, utilities, food, and a bus pass, $178 does not exist. What does exist at $30,000 a year is debt. You use a credit card to cover the gap between paychecks. The average balance for someone at this income is $2,300. At 24% APR, you are paying $46 a month to carry that balance. $46 a month to borrow money you already earned at $45,000 a year. The first number that changes is the credit card balance. $45,000 a year. Take-home is approximately $2,810 a month. Rent takes the same cut, but the gap closes. You have $800 to $1,000 left after fixed costs instead of $600. The credit card balance drops. Not because you paid it off in a dramatic moment, but because the gap between income and expense narrows enough that you stop adding to it. At this salary, you qualify for a car loan you could not get before. A 5-year loan on a $12,000 used car runs you about $225 a month at 7% interest. You take it. Your transportation becomes reliable for the first time. That reliability is worth more than the interest cost. Showing up consistently to a job that might promote you is an investment. Your emergency fund does not exist yet. You have a savings account with $400 in it. It feels like progress. It is. It is also 3 weeks away from zero if you lose your job. The math has improved. The exposure has not. At $60,000 a year, you have $1,000 a month that nobody has already spent. $60,000 a year. Take-home is approximately $3,640 a month. For the first time, after rent, car payment, utilities, food, and phone, you have over $1,000 left. $1,000 that is not already spoken for. This is the first salary band where compound interest starts working for you instead of against you. If you open a 401k and contribute 6%, your employer matches 3%. You are putting in $180 a month. Your employer adds $90. You are not saving $270 a month from your paycheck. You are receiving $90 a month that did not exist before. At 7% average annual return, that $270 a month becomes $47,000 in 10 years without touching it. Your credit score, which was 612 at $30,000 a year because of that revolving credit card balance, is now 694. That 30-point increase will save you $11,000 over the life of a mortgage you do not have yet. At $90,000 a year, $3,000 a month is discretionary. That number does not exist at 60. $90,000 a year. Take-home is approximately $5,210 a month. Rent did not double when your salary did. Your car payment did not change. Your phone bill did not change. Your fixed costs are still roughly $2,200 a month. That means $3,000 a month is not already committed. This is the salary band where the word discretionary starts to mean something. You can buy the flight without checking your account first. Not because you are wealthy, because the timing no longer determines whether you eat next week. Your 401k contribution at 6% is now $450 a month. Your employer adds $225. In 10 years at 7% return, that stack is $89,000. The gap between what you saved at $60,000 and what you are saving now is not the extra $30,000 of income. It is the fact that your fixed costs did not scale with your salary. The people who earned $90,000 and felt no different from when they earned $60,000 are the ones who let their rent grow with their raise. A $1,200 apartment became a $2,000 apartment because they could afford it. The fixed cost base reset. The buffer disappeared. If you held the line on fixed costs between 60 and 90, you kept the $3,000 monthly gap. If you didn't, you are back at $800. At $150,000 a year, taxes change before anything else does. $150,000 a year. Your marginal federal tax rate is now 22% on income above $89,000 and 24% on income above $170,000. Your effective tax rate on the full $150,000 is approximately 21%. Take-home is approximately $8,100 a month. Two things happen at this salary that did not happen before. First, you are now in the income range where a health savings account, a backdoor Roth IRA, and maxing your 401k are simultaneously available and meaningful. The maximum 401k contribution is $23,000 a year. That reduces your taxable income by $23,000. At your marginal rate, that is a $5,060 tax reduction. You did not earn more money. You restructured when the government takes it. Second, at $150,000, your network starts to carry financial weight. The people around you at this salary band know which mortgage broker closes without drama, which accountant finds deductions a software program misses, which employer is about to have an opening before it posts. The information asymmetry at this income level is real and it compounds. At $300,000 a year, your invested capital generates more annually than someone working 40 hours a week at $30,000 earns in take-home. $300,000 a year. Your effective federal tax rate approaches 26%. Take-home, after federal and state taxes, is approximately $14,500 a month, depending on state. Your fixed costs have not tripled since $90,000. If you held the line, they are still under $3,000. That means $11,000 a month is discretionary. At $300,000 a year, you have crossed the threshold where invested capital begins to outpace earned income. At 7% annual return, $400,000 investment portfolio generates $28,000 a year without you touching it. You are earning while you sleep at a rate that exceeds the annual take-home of someone earning $30,000 at work 40 hours a week. 3 things you can do today. Pull your last 3 months of bank statements and calculate your actual fixed cost percentage, not your estimate, the real number. If it is above 50% of take-home, that is the variable to change before anything else. Open your 401k and confirm your contribution percentage. If your employer offers a match and you are contributing below the match ceiling, you are leaving salary on the table. The number is in your HR portal. It takes 4 minutes to change. Calculate your effective hourly rate, take your annual take-home, and divide by 2,080. Then divide your monthly fixed costs by that number. That is how many hours of your life are already committed before you make a single choice. Somewhere right now, someone is staring at an offer letter. The number looks large. It will look different on Friday.